What's good, everyone? Welcome back to a new weekly trading reflection. I got a lot of things to share, a lot of gems, a lot of things I learned this week. As you can see, we're going to go over all of these lessons from this week, and then I'm going to apply them on my bad trades and on my good trades. And as you can see, I got some new lights, so a setup, level up, and also I'm going to make these videos a little bit better to understand for my audience. So what I'm going to do right now is not just go over my trades in my trading journal as I used to. No, I'm just gonna go on my trading view every week like I did this week, and I'm just gonna make some groups for every trade I took, and then on the right here on my object tree of trading view, I can just unhide them, and then we can just like go over them in much deeper understanding, because now we can move over the chart, right? So it's time to lock in 2024. I just turned 20, so let's lock in and go over all these improvements right now. So first of all, I learned that with quarterly theory, the first quarter, especially the X, so meaning the continuation or the reversal, is not always a large price swing, right? I thought an X, if we start the first quarter with an X, that is always looking like something like this, a big move up or a big move down. But now, one of my members in my Discord, he told me like, wait, it's actually also can look like this. We can also have like a previous quarter that looks like a sort of accumulation, and then we start the first quarter of the next cycle, and it can also look something like an accumulation. Then this is not necessarily the accumulation. It can also be the X, which means the continuation of the previous quarter. And in this case, if we look at the previous quarter, this is just a continuation and not necessarily an A. Right, so this is something I learned. I really need to look at the previous quarter of the previous cycle to then determine if it's an X, meaning a continuation of the previous quarter, right? So it's gonna become clear soon. I understand if it's not easy to understand, but it's just something I learned. Is gonna become clearer if I go to today's example. So next thing is I need to use microcycles if I don't really have a good bias, or if I want to take some trades where I'm not sure what the next round liquidity is. So microcycles is something I learned just this week. Actually, I used to only use 90-minute cycles. So meaning if we are in a session, this was Friday, I always go on the 5-minute and basically trade the 90-minute cycles, right? So this was New York this Friday. I just use XAMD, but now you can I realized that you can also go to the microcycles to have an even better understanding of where the next draw is. For example, on the 1 minute, you can see that with this indicator I have right here, quarterly cycles, it divides this 90 minutes in even another cycle, right? So 22 minutes each. So 22 minutes, 22 minutes, 22 minutes, 22 minutes equals 90 minutes, and this is something we also have a true open for, and so we can use this also to frame trade. So something I learned, I'm gonna really use this going into the next week. Microcycles. Next up, look at raw price action and react. So what do I mean by this is sometimes the price is just telling you so much things and you can't neglect it, and especially with the saying like body show the narrative and wicks show the damage, right? I have some examples later on, but what I mean with this is just if you see that there's some big wicks on the downside and price just doesn't want to go lower, then don't force your short bias, right? Always react on what the raw price action is saying you. And raw price action, I just mean like price action, just look at price action, looks what price is doing. Is it respecting a fair value gap? Is it disrespecting a bullish, a bearish fair value gap? Is it sweeping it? What's it gonna do after it's taking out this objective? Is it gonna displace? Is it just gonna sweep? All of this is just raw price action, and I should take actions accordingly if I see that raw price action is not in favor of my bias, etc., etc. So another thing is I need to use the low-hanging fruit. The low-hanging fruit is basically the objective of the whole model, right? So if I'm trading a market maker model like this, and my bias is bullish for the day, then this should be where I should take out most of my contracts and at least put my stop loss to break even. But I noticed this week that I just was way too greedy, and if I had the bullish bias for the day, I would just hold it to the next highs, and I would just hold it because I wanted more. But wanting more every time you trade is just so bad. And I realized that if you trade a model, this is where you should take profits, and I was just way too greedy. So this also just comes down to psychology. I'm neglecting to take profits right there, completely ignorant to the fact that this is actually my take profit. This should be my take profit, and everything that happens after here, if we go even higher, this is just gambling. If I think price will even go up more, the rest is literally gambling, because we need more structure to validate that we're actually gonna go up, right? I'm trading this model. If I'm entering somewhere right here on a fair value gap, then I'm trading this model. This should be my final take profit, right? Of course, I can have runners, but this should be where I take most of my contracts off. So yeah, that's just the biggest lesson. I lost so much this week just because I was too greedy, not taking profits at the objective I should take profits at. So yeah, that being said, it's going to become clear soon. Just want to go quickly over these lessons I learned. Then, need low resistance liquidity run. This is really something I fall in love with. Low resistance liquidity is literally what I need to see every time I frame a trade, because I see working out a lot, and this is, in my opinion, better than equal highs, equal lows, because low resistance liquidity is literally where price will most likely draw to if we are in a kill zone. So low resistance liquidity is basically just trend line liquidity, right? And if we stack up all these highs, in this case buy side, then it's much more likely that if we sweep one high, so let's say the price action is looking like this, right? If we have a bullish bias and we go above one high, then we'll most likely go above all the highs. This is what's called low resistance liquidity, and it's, for me personally, I realized this is the best route. Like by far is the best route, and this is when we have high resistance liquidity. It's when we already sweep a high, sweep some highs, then it's much more harder to go above this high, right? But this is low resistance liquidity, and yeah, then this should be your draw. You should not be scared if this is just if this got taken out, because we should run towards this end of this low resistance liquidity. So LR, low resistance liquidity run, is my best draw I realized this week. Next up, large price swings, Qs. So what I mean by this is that whenever we have a large range of the previous quarter or the previous cycle, the previous day, whatever, you should not trade the next day or the next cycle or the next quarter, right? So whenever we have an overnight session on futures, that's like when so much points up during overnight, then you should not trade AM, and you should wait for the PM session, right? The same thing with 90-minute cycles. If we have an AMDX, but you notice that the manipulation was like the biggest move of the whole day already, then you should expect that the distribution is not going to do much, right? So then you should wait for the distribution to end and only trade the X, so the continuation reversal, right? So large price swings is really an indicator of not trading the current session, and it's fractal, right? It goes about the overnight session, the 90-minute cycles, even the micro cycles. If you have a big price swing, don't trade the current one and trade the next one. Next up, news. News is really just something I realized that is the factor of whether we're gonna have a good trading day or not. So if you, for example, check the news from this week, you can see that on the calendar, this was the news, right? And so I'm gonna go over my trades in a bit, but my trades on Monday and on Tuesday were like the worst ones, right? There was not clear price action, not a clear draw liquidity, not clear models. But then on Wednesday and Tuesday, there was a lot of nice setups, right? And this all comes down to news. Literally, if you have a news day, there's most likely gonna be a nice setup, because news is what drives the market. This is literally just saying to you, okay, this is where we're gonna have moves. So yeah, you're gonna see it later. All my good trades are actually on Wednesday and Thursday So yeah, news is literally where you should look at the first time. I mean, before you open even your chart, you should look at news. Don't trade right at news, but like see if we have a good news day, then you should take trades accordingly after news, right? So or just before news, but not right at news. So I think you understand, but just want to make it clear that news is really an important factor of whether the day is going to be high probable and high volatile. I mean, if the day is volatile, it's most likely also going to be high probable, so it's correlated. So then, one trade doesn't invalidate your initial bias. What do I mean by this? Whenever you have a bearish bias going into the day, so let's say this is the range, this is going on in London, we're opening in New York, I'm expecting somewhere here to start a market maker sell model going towards the external low. So then whenever I short right here, for example, whenever I short right there, put my stop right there because I think the model is gonna happen, but then I got stopped out, it doesn't mean that my bias is invalidated, right? It can still just sweep another high in London session like this and then start the market maker sell model. So whenever I used to get stopped out like this, I would just go all in on longs and I think this is the next trial, right? But sometimes with these models, we just need more structure. We just need to go a little bit higher and still your trade bias, your initial trade bias of the day is not invalidated. So I think you guys grasp what I mean with this. Yeah, just one bad trade can give you some emotions, but you should always stick to your initial bias if it is not already invalidated, right? Because we were still just respecting the equilibrium. So next up, don't neglect the quarterly theory. Don't ignore the quarterly theory. I took some trades this week which were aligning with the market maker models, which were aligning kind of with the order flow and just the way how I trade, right? But some trades I just neglected the quarterly theory and I would just oppose the quarterly theory just because I had some other things saying that this was the next trial. So don't neglect it. I also only need to trade the manipulation and the distribution. I should not trade the X or the A. Never trade the accumulation, never trade it. And if you're in that manipulation phase, just wait for the manipulation phase to end. Wait for the last sweeps and then you should have a clear bias of where distribution should go to. So don't neglect the quarterly theory. I'm always gonna have either micro cycles, 90-minute cycles or the daily cycle as a confluence. That's just something I learned too this week. Last thing is I have set some new risk rules for myself because I kind of have like my initial risk plan, which is just 1% a day and 2 shots per day. The rest is tape reading. But now I kind of add some 2 more rules, which is basically if I have like a trade setup, I can have 2 attempts, right? So I can have 1 attempt trading that setup I see with the bias, with the drawn liquidity. If I get stopped out and I see the trade still playing out, then I can still re-enter, right? Because I maybe just had a bad stop loss, to break even, whatever. I can have still 1 attempt with 1 model, right? So 2 attempts with 1 model, and also I can scale into my winners, right? I had a good trade on Friday, and basically I'm gonna stick to 1% risk per trade. But if my trade is playing out good, then I can scale in, so I can enter again. I can add more contracts with the same take profit, but I just move my stop loss of my first entry to break even, and I'm still only risking 1%, right? So that were my lessons from this week. But now it's gonna become way more clear because in each of one of my setups I'm gonna share now is at least one of these things is a factor of why I lost or why I won. So let's go over my trades. First of all, we're gonna discuss the Monday L. Let's look at Monday. This was the Monday losing trade. Why was this a losing trade? So let's go to the 1 minute. I think this was because I neglected the quarterly theory. So this is a nice manipulation, right? We sweep the highs, then this should be the distribution. The only reason why I thought this was the manipulation is because right at the New York Open, we swept this high, but I didn't know about the microcycles yet. So within each quarter, within this distribution quarter of the 90-minute cycles, we can also have a manipulation quarter, right? Because if we zoom in, I mean, you can divide this into 4 as well, right? And if we divide this into 4, just gonna do it really quickly now, not pretty accurate, then you can see that this first quarter is just an accumulation, then this is the manipulation of the distribution quarter, then this is the distribution, which doesn't present good price action. Why is that? Because I learned this week that if we have large price swings quarters, you shouldn't trade the next one. Again, here you see that happen, right? This is the manipulation because we just opened the market, swept this high, a very big move up and down. This should be the distribution, so you expect, okay, this is just gonna go down also, but because this was a large price swing, you should expect to not trade this one and trade the next one, which exactly happened. So I'm just adding all these lessons from this week to my trades. This looks like a clear AMDX, right? Sorry for this indicator, I know it's so ugly. I do really want another indicator, but I can't use any other of that as of now. So the thing I learned from this is, yeah, just I didn't know what I just thought this was the continuation quarter, but it was just an accumulation. This was the manipulation, distribution, continuation. And so, yeah, I thought just because of these SMTs and disrespect of this fair value gap, taking this inverse would go towards these highs. But yeah, not a good trade because I was neglecting the quarterly theory. And then the SMTs really doesn't have any context, right? And SMT should be aligned with the bias, otherwise like you can't use it, right? Again, with this minute 15 fair value gap also, if it's not aligning with the bias, it will just run through it, right? So that's also something I learned. So that is it for Monday L. I'm gonna leave that one. Let's go to Tuesday AM chop. Let's see. Let's see. I think again the same thing as the previous trade. Look at this distribution quarter. So looking at this is a clear accumulation, right? This is a clear manipulation, right? This is a clear distribution, but the distribution, this big distribution move happened during the manipulation of the distribution. Right, so this can also give me a bias of price doesn't want to go lower. Also, aligning time and price, you see that this big move sweeping this low happens exactly at 9:30, which is often referred as the Judah swing. So because we have a clear bias formed by the 90-minute cycles, which is A, M, D, and notice again, applying this lesson, large price swings quarters, don't trade after them. You see that the distribution had like a big move down. What happens in the next quarter is just chop, chop, chop all over the place, right? So also adding another thing I learned from this, applying this look at the raw price action and react. If you look on the 50 minutes, look at this, it swept this low, and then closed really bullish. Again, big bullish wicks, This is just looking at the raw price action. Just seeing this tells me that price wants to go higher. Of course, now in hindsight, I was still looking for shorts here because I didn't see this at this time. So after I noticed this, I took a banger of a trade, unfortunately just making the losses back of all these lost trades. Because again, low resistance liquidity. If you look on the 1 minute, why did I take this trade? Let's see, where is this? Look at all of these highs getting stacked up right here. All of these highs is what's called low resistance liquidity. And whenever we have time and price aligned. So what I mean by this, we go higher, we respect equilibrium. What do? We disrespect this 1 minute fair value gap, and then we use it as an inverse, right? We're just creating some wicks in this inverse. Then I know we're ready to go, and I took this banger of a trade all the way towards the highs of New York session. So yeah, as you can see, the New York session was just chop all over the place. So what you can expect is the next session is gonna have much more clear price action. And look at this, it's just so beautiful. You can just add positions right there because the draw from here is clear, right? So next trade, let's delete this one. There's so much value in here. There's just so much value in here. I know you at least gonna learn one thing from my journey, and I hope that you learn something from me, because that's my goal. So let's delete this one. This is Thursday missed trade. Let's go and look at this one. Sorry, a lot of drawings right here. This is just a nice market maker model. Let's look at what I did right there. Oh yeah, so I missed this trade, right? So someone in my Discord, he took this trade. It was really clean. We had a move up during New York session. What happened? We respected this fair value gap. We have a big move up, start of a potential market maker buy model. Look at all these stacked highs. Again, this is just the reason. I don't really care about the original consolidation right there, which is the objective of the market maker buy model. Just if we have some clear stacked highs, this is just indicating, okay, whenever we have bearish PDRAs getting disrespected, like this first fair value gap that got disrespected, you can have an entry right there on the unicorn, on the breaker that got disrespected, on the order book that got disrespected, which turned into a breaker. So yeah, beautiful trade. I missed. Someone in my Discord took it, and it also aligns with the 90-minute cycle. So applying that lesson for me, I should look at the 90-minute cycles. This literally was just a I think it was X, because it was a continuation of the previous quarter. Then it was A, you see, clear accumulation, then an M here, and then a D. So just using micro cycles alongside with just knowing how markets operate, they move from equilibrium to fair value gap to liquidity. Equilibrium, fair value gap to liquidity, right? So what do we have right here? We move to equilibrium to fair value gap, fill it. We are bullish, so we should move up here. So we attach it to a 1 minute market maker buy model. We align with we align the structure with time, so with quarterly theory, the microcycles, and you just have a beautiful trade, right? So that was a missed trade of Thursday. Let's go over the break-even trade on Thursday. Let's look at this. I'm gonna make this a little bit. Can't I just shrink this down here, like that? Again, anticipating a market maker buy model right here. Why? Smart money reversal usually happens with an SMT. So ES swept this low. We had a minute 15 breaker starting from here. I'm not gonna go over that chart because I need to go back way in time. So this is the minute 15 breaker. We have an SMT right there. What do we see right here? Again, stacked highs. Stacked highs is literally the sauce. Stacked highs, stacked lows in the form of trend line liquidity is literally the best thing to find to draw liquidity. Again, here, SMT, inside equilibrium. If you're bullish, we should expect, again, a big leg up. We align it with the microcycles. We have a clear accumulation right here. We just do nothing. Then we have the manipulation, which is the forming of the SMT right here. We should have a distribution. So we align the quarterly theory, microcycles. We align the bias. We align the market maker buy model. Everything what I need. So I took this trade after the first PDRA got disrespected. I took this as a fair value gap entry or an inverse, whatever. I think also a unicorn entry because we tapped this breaker. And yeah, this is the low-hanging fruit. And I didn't take profits at this low-hanging fruit. This is the most important lesson from this week. Take profits, don't be greedy. If I trade this model, this should be my take profit, right? Even if I have a bullish bias going today, look at my take profits. They were just like at the all-time high. This is literally gambling. I realized this is literally gambling. After this low-hanging fruit, which is the objective of the model, is taken out, I should take most of my contracts off because my trade setup played out. I should be happy, take profits, good risk reward also. So yeah. Also, I had the invalid break-even level right here. After I saw price moving up, what happened? I put my stop loss to break even, which is the low of this fair value gap. So where this gap opened, and literally I just got stopped out to the tick, and then I re-entered because I just wanted this objective to get taken out. But going into next week, my break-even level will be at the low of the, at least the body open of the fair value gap. So yeah, bad trade management. Trade management is my only thing I really need to work on, together with my risk and just the psychology kind of things. I feel like the technicals are really going good, but if you don't have good psychology, a good mindset, good trade management with risk management, then you're fucked. You need to have you need to have your full force, right? And I didn't have that right here. So that was the break-even trade because I didn't take profits. So going to the next trade, which was on Thursday, this was a win. Yeah, so this was the most beautiful win of the week. I really read this price action really, really good. I was expecting this to be the high of the week because looking at the economic calendar, Wednesday had a lot of red news folders. And Tuesday and Monday didn't have any. It was just no news Tuesday, no news Monday. So if we have that news starting on Wednesday, it should most probably be high, right? And then we reverse and continue the week on Thursday and Friday. So I was expecting this to be the high, and then I just wanted to see a market maker buy model, an internal market maker sell model from the premium here inside the 1 hour fair value gap. So after I saw price hopping into the hourly fair value gap right here, let me just delete all of this. It's not really necessary. After I saw price tapping inside this hour 1 fair value gap, I was expecting, especially looking at route price action again. What do you see right here? You have a high. Look at what the next swing high is doing. It's not really doing anything. It's just like a manipulation, right? It's not really displacing above this. So knowing this, knowing that we were also in a premium inside a 1 hour fair value gap and an SMT is formed with NQ and ES, I was really confident that because we have this low resistance liquidity, look at all these lows. These were all the lows that were formed in the overnight session and just the previous days. So this is a clear draw on liquidity, right? We were also above the true day open, above the true session open. So you want to short above these. So this was an ideal setup. I was really confident with it. I even added right there, which I'm going to go over in a bit, but let's look at my entry first. So this is kind of my favorite entry model I realized this week. Whenever everything is aligned, whenever we have the SMT, start of the potential market maker sell model, and we disrespect the fair value gap, a bullish fair value gap, and we use it as an inverse, then I know we're ready. I just market enter right there, and as you can see, beautiful trade. And I scaled in right there. So whenever price was here, stop loss was set to break even, and I can even add more contracts to my trade because I was so confident that this was gonna be the draw with my bearish bias going into the day. So again, the same entry model. Whenever we are tapping again in the internal premium, we sweep this high. We have another internal stop rate. We disrespect this fair value gap, use it as an inverse right there. I just enter right here. I added another 2 contracts right there, and yeah, as you can see, price and time have aligned. After I enter, no drawdown at all. It just rips because everything looks good, right? I was so confident in this. Really helps with my conviction in my model because I see it working out. Again, the same thing right here, another price lag, sweep this highs, an internal stop rate, disrespect this fair value gap, use it as an inverse, and we're ready to go. So beautiful, beautiful day, best day of the week. So yeah, that was Thursday, beautiful trade. Before we go into Friday, I forgot that I had a Wednesday paper trade right here. So let's go quickly over this one. This was just a market maker buy model. Again, we have all of these highs right here. We have an SMT, we displace. This is what we need, right? We need a big displacement candle showing us that we are ready to go higher, right? So it should be better. I agree to wait for this to get disrespected to fully and then use the inverse. But yeah, it was just a paper trade. It looked good. SMT, start of a market maker buy model. I think the quarterly theory also aligned with this. We have an continuation of the previous quarter. We have an accumulation right there. We have the manipulation which formed the SMT and then the distribution. So aligning time and price meaning market maker models for me, and yeah, displacement, and we're ready to go. This is where you should take profit. So learning a lot this week. Let's go over the last trade, which was a loss on Friday. It was also my birthday on Friday, so I was kind of having a bad headspace because I just wanted to take wins on my birthday, which is not good. I think next year I'm just gonna stay away whenever my birthday is and not trade then. Yeah, this was that trade on Friday. Let's go over it. Now, I know you guys might have noticed that I project some of these accumulation ranges right there, and I really can't share this because I'm in Dave's private mentorship, and I mean, he told me that I can't share this because I mean I paid for this. It's really exclusive content. But yeah, just quickly said, you can project these Q1 accumulation ranges to project the lower highs or the retracement, the swing highs, swing lows, local lows. I'm not gonna go deeper into this because I respect Day and I don't want to share anything that he doesn't like me to share. So everything can still be formed without this. It's just some extra confirmation. But going into the day, I was still expecting on Friday to just go lower, start this high time frame market maker sell model, because as I said in the previous day's trade, this is most likely Wednesday going to be the high of the week. So again, like the previous day, I wanted to see some nice market maker sell models inside the premium of the dealing range, right? So again, here, what do we have? Our dealing range from Friday. On London session, we go up, and on New York session, I'm expecting the market maker sell model to start. So we had this hourly breaker right there. Let me just delete this premium discount tool. This was, I think, some hourly order block. And going into the day, like I said, I had a bearish bias, but because I thought this was going to be the start of the market maker sell model, we disrespect this fair value gap, we use it as an inverse, I thought we were ready to go, right? So this could have been a good trade. I should have taken profits right there after I saw we tapped this hourly fair value gap. So trade management is the most important thing. If you have good trade management and good technical analysis, you're ready to go. But this is still lacking for me, and we had this hourly fair value gap. I thought this was the start of the market maker sell model, and it was a good trade. I think I was in profit for like 1.75 R, something like that. But I failed to see what price action, what the raw price action is telling me. And looking at the 5 minute, especially looking at the 50 minute, what is this telling me? It tells me now, in hindsight, of course, that we are respecting this equilibrium, this hourly fair value gap. Look at all these wicks. Look at all these wicks. We create a wick, close bullish, create a wick, close bullish, create a wick, close bullish. So at this time, I should take profits. My bias was good, but New York was just gonna make another high to then start the market maker sell model. So a little bit frustrated because my trade management was really, really bad. But after I saw and realized that we were respecting this, I got stopped out of break even. My bias changed and I was looking for longs. So then I was looking for an internal buy model, which again, why is this such a good buy model? All these stacked highs is telling me, okay, this is gonna be the next draw. But a big mistake I made here is, let's just first discuss my trade ID. So SMT, stacked highs, market maker buy model, projected this last manipulation move, and it was aligning with this high, a clean high, still in premium, just in premium of this whole range. So I thought this was the next draw. But the problem is, because my first initial short trade of the day got stopped out, I was just bullish for the whole day for no reason. And this is what I mean with this lesson, is that one trade doesn't invalidate my initial bias. We can still have some more structure to form this market maker sell model, right? Maybe this is just gonna be another sweep, and then we're gonna start the sell model, which eventually happened, right? So for a market maker sell model, for a clean one, we need a lot of stacked lows. And looking at this price action, this can be a start of a market maker sell model, but we can still go up. We can still sweep this high because we really didn't have an SMT or a clear stop rate right here, I think. And at this time here, we had the stop rate, and this was the initial market maker sell model. But what did I do? I was just too bullish going into the day because I got stopped out of my short. I was completely neglecting my initial bias, and I wanted just to hold it towards the highs, towards the all-time highs. Way too greedy again. Use low-hanging fruit. The biggest lesson of this week: don't be greedy. Take profits at a good risk to reward. This was at a risk to reward of, like, let's see, it was at 3.36, so it's a very good risk to reward. But I was just do something else, doing a workout. I was just hoping that, okay, we're here, we're most likely going to take out this next high. But I need to realize that everything after we sweep or we displace through this high is just gambling, because I traded this model, right? I traded this model. So whenever this highs get taken out, like, the rest is just pure gambling. And I just trust my gut, trust my intuition. But you should never ever trade based on intuition. You should only trade if there is a clear model, a clear entry model present. Otherwise, you're just gambling. And so big L. I could have been up. I could have almost passed my combine this week, but I completely just lost the profits from the previous day, but from that amazing trade, because just poor risk management, poor trade management. I over risked somewhere, and learned a ton this week. Even after I see an SMT right there, so I think this was the SMT. This goes back to looking at raw price action. Even if I see this SMT and then big displacement down, I was still confident, like, we're just rebalancing to equilibrium before going higher, right? Which can be, but you shouldn't trust your intuition. You should only trade on models, on entry models, like I just said. So whenever I see price action telling me SMT at the highs, we don't really displace if we go above these highs, we really just accumulate. Then we have a displacement down, just trust this price action and take your profits. But no, I was just expecting to still take out this high, which didn't happen. I was just looking at the price, we're still gonna go up, but it isn't the case. So look at price action, look at conflicting signs, which is an SMT, big displacement. Just take profits. Most important thing from this week. I feel like my technicals are alright. I'm really learning so much. My technicals and my way of reading the market has been improved a lot. I really build a passion from this. I really love just explaining these things because it makes it clear in my head. I hope you learned just something from this video. It's time to lock in. I just turned 20. No time to lag. 2024 is going to be my year. I just know it. I need to put in the work. Less talking. And let's go to the next week. Peace out.